Hi guys, hello everybody. Nice to see you all online and chatting. It sounds like everybody is very happy that we're getting close to the end of the semester. And hopefully everybody was happy with their task 2 results. Yes, Prema, I'm glad your marks were sorted out. Sorry about that. It's just crazy how it was you both times. If there was something funny with the marks, it's weird that happens. Need to start studying. Start? You mean you haven't started already? Okay, so I know you guys don't need to be reminded, but for anybody that's listening to the recording, your exam is 21st of June. So basically, you guys have got 3 weeks to go. So that is a nice amount of time. So if you start studying now, 3 weeks is a perfect amount of time to do your revision for the exams. And I know you guys, like Prema particularly, I know you guys have been working hard throughout the semester. So if you've been working already and hard for your task 1, task 2, then you've already covered that work, and all you need to do is revise it, and then obviously study your exam chapters, which are just those last couple at the end of the textbook. Oh no, really? Eye surgery? And, oh no, you've got the flu. I'm dreading getting the flu. I went last week to get the flu shot, and the sister told me, no, they just ran out. They just gave somebody the last shot, so I still haven't had mine. I need to go back and get it. I really do not want to get the flu. I just don't have time for that in my life. I know exactly, and I've seen a few people that have been seriously sick with it, including my son-in-law. It's really not nice at all. So that actually just reminds me, tomorrow I must just make a plan and go and get it after voting. Hopefully there'll be places that will be open. No ways, Christopher. Seriously? Wow, that's awful. That's really bad. What was that? Your chest? Pneumonia? Did you get pneumonia? It's quite scary the way these flus just mutate, and they some years they come out and they are just really so viral. Awful. Gosh, well, I hope you are okay, Christopher, because that also would have put you out of not working, because when you're that sick, the last thing that you're able to do is pick up a book and concentrate on work. Oh, wow. Oh, gosh. Wow. Yeah, that's a real lesson. And I mean, you guys are young, so your immune system should be strong. So that's just a real lesson to all of us. Okay, guys, I don't see anybody else joining now. I was just waiting to see if we've got any more victims for the evening before I start, but it doesn't look like it. So what we've got tonight and next week are our last 2 sessions. Oh, here comes somebody else. Are our last 2 sessions. And so we're just going to do exam revision. So what I've got for you guys this evening that we're going to go through, and we'll just get as far as we can. We might finish, but if we don't, I'll either finish off next weekend or do a separate recording for the rest if we don't finish it. So tonight we are going to do the exam from 2023, and that was the first version of the paper. So I'm hoping that that's the paper that they've uploaded on the e-library. They upload the first version. Yes, and I'll post the paper just in case they don't. That's not the version that's uploaded in the e-library. And then just remember, I'm not allowed to post the memo. Okay, I can post the question paper, but we're not allowed to post the memo. I actually saw this afternoon that a lecturer had said that they were posting past exam papers with memos for students, and that's absolutely not allowed. So I don't know what's happening there. I'm going to find out I suppose I'll have to wait till Thursday and just see if maybe it's changed and we are allowed to do that, but we're strictly not allowed to post memos for students. Lots of different reasons. One of the main ones being that students tend to take papers if we post them and they upload them on these various websites, Chegg or Chug or whatever they're called, and these types of websites, and it causes a problem, as well as various other reasons as well. So I know it is just unfortunate. So that's why I try and cover as many exam papers as possible in recordings so that you guys have got them online to go and have a look at, because in that way I kind of get around the fact we're not allowed to actually physically post them. Absolutely understand. And if you're stuck with any question that you're practicing in the exam, then just let me know and I can always help you to see if you're on the right track or not. Obviously, just remember, I can't mark papers. If you practice a paper and send me the paper, I can't mark the paper. There just quite simply isn't time to do that with the volumes of students that we've got and the other work that we've got. But if you've got a problem with one question, I'll definitely try and help you. So if you go and have a look in your YouTube recordings, the past recordings, you'll see for you guys there are, I've gone and put that away now. I think there's 2 or 3 exam papers that are already recorded there. And that's why I've chosen a different one to record this evening, so that over time I can build up the number of exam papers that are in your recording. So in your recordings already, if I remember correctly, there is already the 2018 paper, the 2020 paper, and a 2022 paper. What did I say? 2018, 2020, and 2022, that those are already in or on, how do you, I don't know how you would say that, in YouTube. So tonight we're going to do 2023, so that will be a 4th exam paper. So that's plenty for you guys to use for practice with past paper, because remember, as I said in that posting I sent out this afternoon, your main source of study must be your textbook. That is really where all the information that you need resides. And if all you do is really study hard out of your textbook, that is sufficient. If you've got time, you can then practice for some past papers and then just see how you go. So definitely in YouTube, there will be, by the end of this evening, four past papers you can go and practice with, and that should then be plenty to give you a good idea of what to do in the exams. Because remember, even if we've got 10 exam papers uploaded there, in your exam paper, they could still give us several questions that have never been in past papers before, and they would still be new questions that you've never seen before. Okay. So that's why I don't like students to rely on past papers, because that's no guarantee you're going to get those same questions. Yes, exactly. And particularly when we do from time to time, they change the examiners and then the questions change or the papers change. So the important thing is that you understand the principles, that you know all of your formulas and you know all of those variables in all of the formulas, and how to work out the values that you need to substitute into those variables in all the different formulas. Yes, but you've got plenty of questions in your textbook, particularly in the chapter, and then the revision questions at the end of each chapter are really good questions to practice for exams. And in fact, you'll find that those revision questions at the end of each chapter often are the questions that they've based the exam questions on. So your textbook is a good source for practicing with. And then obviously they'll always have some questions that will test your application of your knowledge of the different calculations. And also, please, guys, remember your formula sheet. You absolutely must work and practice with the formula, print it out. It's just a few pages. You don't have to print those tables. You can use your textbook for that. But those other couple of pages, print them out so that you are doing your practice questions with the formula sheet next to you, and you're using the formula sheet to then do your questions, because in that way you are, what's the word, you are simulating working at the exam only with what you will have in front of you, which is your question paper and the formula sheet. And then that will force you to remember the formulas and the variables and which formulas are not on the formula sheet itself. I think I did upload your formula sheet in your more resources, if I remember. It should be there. And if not, it's if you download any past paper from the e-library, the formula sheet is always attached to those past papers. I did. Okay, great. I never remember with all the different modules that I do with which ones I've remembered and which ones I haven't. Okay, anybody got any other questions before we begin looking through the actual paper itself? Anything else that you want to know or you're not sure of? We still have another session next week, so thanks, love. You have got time, and then obviously you've still got a couple of weeks. We've got 3 weeks before you actually write, so you've got plenty of time to go through your work and ask me any questions if you are stuck. I will be keeping obviously an eye on my emails, etc. During your study time, because I'll be already marking papers. My first module, write the exam on the very first day of exams, which I think is the 17th of June. I know it's that very first Monday, so I'll already be working on that. So I'll be available for any questions. Okay, so I'm going to go and share my screen now so that you guys can see the papers. And then I'll check in from time to time to see if there are any questions in the chat box. And then don't forget, you can use the microphone at any time. Okay, so there we go. So I'm going to go over to PDF. Make this just a little bit smaller. Okay, well I'll just make that a little smaller so we can see. Okay, so this is, as I said, the 2023 exam paper, the first version. So let's have a look at what they had. We've got a company producing cricket balls. They want to expand operations. And they have had the following cash flows have been projected. In year one, there's a cash flow out of 19,250,000, and then we've got 3 years of cash flows in. So remember, with this type of pattern of cash flows, do you remember what we call this type of pattern? We've got 4 different years of cash flows, and each of those amounts are different rand values over the time. And what they've asked us to do is calculate the future value. And again, guys, in the marking of the task 2s that I've had, particularly for some of the modules, maybe not so much yours, the students throw marks away because they haven't read the question carefully and they haven't done everything that was asked of them. So here we want the future value of the cash flows. You must use the financial tables. So in other words, use your tables provided and look up the factors, and assuming that the cash flows will occur at the end of each year. So yes, this is called a mixed stream of cash flows, and each one of these cash flows will be treated as an individual lump sum. So we will use the future value of a lump sum of R1 table. So you must make sure you've identified the correct page in your financial, in those tables of your of the factors. So they've asked us for the future value. So you'll have two future value tables. The one table will say future value of R1 and the other one will say future value of an annuity. So just make sure for this question you're using future value of R1 table. Here they have given us our opportunity cost is 15% per annum. So remember, they could use the term opportunity cost, cost of capital, weighted average cost of capital, required rate of return. All of that terminology refers to the same phenomenon, which is we must use 15% to calculate the future value of our amounts. So we are going to go to our table. We are going to use the column headed 15%, and then for each year, if these cash flows take place at the end of each year, what factor are we going to use for this first year? Okay, we want the future value. So our future value is, just make that a little bit smaller. Sorry, get that even smaller. Our future value will be in that corner. Our present value is right up here at the beginning of year one. And we now have to calculate the future value. So this amount here, and the cash flow takes place at the end of each year. Okay, so this is where the cash flow, the actual cash flow, takes place at the end of the year. So we are going to take this amount from here at the end of year one, and we want to value it here at the end of year 4. So we are compounding that amount of 19,250 1, 2, 3 times to get to the end of year 4. So that means that we are going to use 15%. Where's my, and the factor from year 3 on the table. Okay, I don't know if you guys have got your tables with you. Hopefully you have, either in your, if you've got your textbooks, they'll be at the tables are at the end of learning unit 2. Okay, did you guys see how we worked that out? So just go back and have a look here. This amount, we are going to go forward 1, 2, 3 times. So 19,250 multiplied by the future value factor for 15% and 3 periods. Then the next one, the 17 million, we are going to go from the end of year 2 and we're going to go forward 1, 2 times. So 17,450 multiplied by the future value factor of 15% and 2 periods. And then this one, for year 3, we're going to go forward once. And this one here, the 14 million, in year 4 is going to be 14,150 multiplied by 1, because that cash flow takes place right at the end of the 4th year, which is at the future time. So 14,150 will be its own value. That value won't change. Okay, so here's our factors. This is 15 and 3. This is 15 and 2 periods, 15 and 1 period, and just multiplied by 1. because that value remains the same. So with these questions, what you've got to do is practice, take the same table as this question or any question and work those amounts out. What if they asked me for the present value, if the cash flows took place at the beginning of the year, and if they took place at the end of the year, and what would the values be if they asked me for future value and the cash flows took place at the beginning of the year or the end of the year. So that all four of those different methods, you've practiced them and you know you can get this factor correct, because that's where the students make the error, is they start out with the wrong factor for the first year and then all the rest are then incorrect as well. So that's just practice until you're comfortable with working out correctly how to identify that factor. And remember, if they don't ask you for the tables in any question, you are free to use the tables or your financial calculator. It's entirely up to you if they don't specify which method that you must use. And then also don't forget, there's something else I've noticed that students are doing. When you've calculated this over here is just a typo. Sorry, you'll see in this particular paper there are, let me get that. There are quite a lot of errors. So this is the future value, not the present value. Why is that? This is the future value. Is don't forget to add the total together. There is, as you can see, a mark for the total as well. And don't forget, if the cash flow is negative in brackets, that your future or present value is also then in brackets, and then when you add up your total, that you remember to subtract that one and add the others. Just those little things. I can't tell you how often students lose marks for small mistakes like that. And I know they're easy when you're in a hurry and you are nervous, but just try and force yourself to double check yourself all the time that you've done the correct, you've tied up all those little ends. Okay. So that's only a 5-mark question, but you can see just in that 5-mark question how much you can practice by just using that question to make sure you've understood that whole present and future value, beginning and end of the year story. And they will always, I'm sure, give you one or other question with that, because they will constantly test the students to make sure that you are getting that correct. Okay. So then let's have a look at question 2. So question number 1 was out of Learning Unit 2, just if you want to make a note of that. Question number 2 is from Learning Unit 6. I think that's our, what's that? That's our capital budgeting application. And let's just go straight to the required. This is something that I like to tell the students to do when you have a look at the question. Before you go and read all of this information, go to the required and just have a look to see what are they asking me to do, and then go back and read the information. So here they want us to calculate the payback period for the Johannesburg Academy. And always remember, there is an and. Don't forget that second bit of information that they want us to do. Advise whether they should go ahead with the project. And that's for 13 marks. And then for 5 marks, advise the directors about the concerns you have about them making decisions based solely on the payback period method. So remember, in your learning objectives and in the theory in your textbook, you've got the advantages and disadvantages of all of the different methods. So clearly here for 5 marks, they want you to talk about the disadvantages of the payback period method. Okay. So now we know what they've asked us to do, we can go and have a look at the information. So we have got a table of cash flows, initial investment, and then 7 years worth of cash flow. So also always remember this initial investment, if it says investment, that is always a cash outflow. It will always be a cash outflow when it's an initial investment. So even though they don't have it in brackets, please remember that so that you remember to keep that as a negative amount. Then they have said the cricket nets will need to be repaired at the end of every second year at an expected cost of 200,000. Then at the end of the 4th year, where the cost is expected to have increased by a further 50%. So in other words, the 200,000 plus another 50% at the end of year 4. Then in year 6, we've got to upgrade the field at a cost of 1.250 million. At the end of the 7th year, we are going to sell the facilities, and the estimated selling price is expected to be 6.5 million. So what they're saying is all of the above cash flows have not been taken into account in the projections below. So they've given us a table of cash flows here for 7 years, and then they've told us in addition to these cash flows, we must also take into account in year 2, we're going to have, and remember these are cash inflows, in year 2 we're going to have an outflow of 200,000. At the end of year 4, an outflow of, what will it be, 300,000. At the end of year 6, there's going to be an outflow of 1.250, and then at the end of year 7, an additional inflow of 6.5 million. Again, students make errors with this type of question only because they don't read this information carefully, and they subtract instead of adding, or add instead of subtract, or they put it in the incorrect year. Slow down, take time, read carefully. Always, please guys, take highlighters with you. And as you can see, as I read these papers, I'll read them with a pen in my hand and a highlighter, and I will highlight the information that I know I need to action in the question, and I'll make notes above certain wording that I also need to remember or take into account when I'm doing the question, so that when I go back and I do the question, I've already got all those notes and highlights, and I can then quickly do the correct thing when it comes to doing the work-ins. Also, please don't forget, write all your work-ins down on your answer page in the exam. Also, mark in task 2, particularly for my first years, not so much you guys. Goodness, they just did not write their workings down, and they lost so many marks because of that. If you've done any calculation whatsoever to get to an answer that you've written down on your answer paper somewhere, write down what that calculation was. Because sometimes if your answer is incorrect, I can still give you some marks for parts of the workings that you've got, but I can't give you those marks unless you've written them down on your answer paper. Okay, so the first thing that we want to do is, let's just go and have a look at the rest of the information over here. They've told us that for Joburg, they've got a cost of capital of 11%, and there's a targeted payback of 4.5 years. So for our required 2.1, we need to know that the target is 4.5 years so that we advise them correctly when we've done our calculation. Okay. So everybody have a look at what we've got here in terms of our information. So now let's go and have a look at what that calculation for the payback looks like. So year 0, we've got the outflow. In year 1, we had the first inflow. So in this first column, we are writing the amount of the cash flow for that specific year. So in year 2, this is the addition of the minus 200 that we included to get our new cash flow. Year 3, there was no change. Year 4, we had to take that 200 plus another 50%. So year 4's cash flow has changed. And in order to get to as far as we needed for the payback, we only needed to go as far as year 5. In this column, it's the cumulative cash flow. So we start out with a running total. Remember, cumulative means a running total after each year's cash flow. Oh, why can I never spell when I'm doing this? We go back. There we go. Okay, running total. So cash flow out, year 1, plus the cash flow in from, year 0, plus the cash flow in from year 1, plus the cash flow in year 2, year 3, year 4. So right up until the end of year 4, we still had a cumulative negative. And then after adding year 5's cash flow, we then had a cumulative positive cash flow by the end of year 5. So remember, that always tells us where we go from the last negative cash flow, where the next year is positive. That is where our payback is going to take place, somewhere between year 4 and year 5. So we know it's going to be 4 point something years. So in your answer, you write down 4 years, so the number of years where you had the last negative amount, plus, and then we do our calculation to work out what percentage or what proportion of the 5th year do we need in order to get to that break-even point. So we take the negative amount, the remaining negative amount, 250, over the next positive inflow. Excuse me. So 250 over the 3.5 million, the next positive inflow. Sorry guys, I've just been talking so much today. So 250 over 3.5 million is 0.07. So we add that 0.07 to our 4 years, and our answer for payback is 4.07 years. Then we are going to compare that to our target payback, which was 4.5 years. So our payback on this project is less than our target. So therefore we can say, yes, accept the project. And you must give a reason. You can see there's a half a mark for saying accept the project. And if you don't give a reason, you'll lose the second half a mark, as the payback period is below the target payback period of 4.5 years. They do want all of that information, not just, yes, do it. Okay. Sorry, guys, excuse me. All right, so everybody happy with the payback calculation? Then for 2.2, that's a theory question. So that will come straight out of your textbooks, Learning Unit 6, page 170. And as I said, this will be all of the disadvantages of using the payback method. So you can see how they've laid it out neatly in paragraphs. And again, my goodness, when you guys write opinions or paragraph questions, some students will write half a full scat page without lifting their pen. If you've got a new point, you leave a line and you start a new paragraph, okay, so that you'll whatever you've written can be followed by the marker easily. The different points that you are making can easily be identified, and you're making it easy for me to award marks. When I've just got this long half a page of writing, it's very difficult to work out what the student has written. So that is important. So just have a look at that when you are answering. Remember, there's plenty of paper in the exam room. You can ask for as many answer books as you want. So don't worry about how much paper you are using. Start every new question at the top of a new page. Make it easy for me to see what you've done, and leave yourself plenty of space in that answer booklet for spreading your workings out and being clear about what it is that you've actually done. Then still going with question 2, because remember this question was for 45 marks. And here we had cash flows for Joburg. Upon further analysis, they also want to have a look at Durban and compare Durban to Joburg to see which of the two is the most feasible. So they've then given us a table for Durban's cash flows. Again, initial investment, cash flow out, year 1, 2, 3, 4, and 5. And in this case, they've given us a little description for these two cash flows, which means you must do a calculation to get these amounts correct. And as simple as it looks, you won't believe how many students will do that calculation incorrectly. Increase of 15% from year 1. So in other words, year 1 plus another 15%, not just 15% of year 1, okay? It's an increase of 15%. And then in year 5, a decrease of 20% from year 4. So year 5 will be 80% of the cash flow of year 4, not only 20% of year 4. Read very carefully. That says an increase of. So it's year 1 plus another 15, and a decrease of, which means it's year 4 minus 20%. And then again at the top here, they've told us at the end of the 3rd year, we have to replace nets at a cost of 975,000. And at the end of the 5th year, we are going to also sell the whatever this facility that we're going to be developing. We're going to sell it at a selling price estimated to be double that of year 1's cash flow. So year 1's cash flow doubles 3.4 times 2 is then going to be a cash flow in at the end of year 5. Okay, so at the end of year 3, we're going to have a cash flow out of 975 in addition to what we've got on this table. And at the end of year 5, we're going to have a cash flow in addition to what we've got on this table. So you can expect these kind of changes. In the old days, they used to give you guys a table with all the Rand values written in, and all you had to do was take the Rand values and then do the present value or future value or payback calculations or whatever. So they will make you do little calculations, and just pay attention. Read carefully and slowly, and then you'll easily get all of the marks. Okay, so our required here for 2.3 is calculate the annualized net present values for both Joburg and Durban. And then once again, and circle that word "and" so that you don't forget after you've done all your calculations, you don't forget to go back and advise the management which academy they should invest in based on the ANPV method. So our question, this question 2.3 is in Learning Unit 7, page 208, annualized net present values. And that's page 208 in my textbook, so it might not be exactly the same in your textbook. So remember, in annualized net present value, what we are doing there is that we have to calculate the net present value for each of these tables of cash flows. And then we have to calculate the annual annuity or the PMT value that would give us that net present value. So in other words, we are restating the net present value into an annual annuity as if it was an annual annuity. So an annual annuity just means an equal annual PMT that would give us that net present value. And that's also the reason that we do that, is also just so that we can make two different projects of different useful lives or different lengths of lives, that to make them comparable. Because we've got 7 years for Joburg and our project for Durban is 5 years. So let's go and have a look at that calculation. So in this memo, they've used the financial calculator version of ANPV. But remember, what we're doing is calculating net present value. So you can use the financial calculator version, or you can write down each of the cash flow amounts. So here we've got to go through all 7 years, the whole lot. And then you could multiply it by the present value factor, and then add them up to get the net present value. Okay, so either method is fine. In this particular one as well, this answer is not correct. Again, depending on whether you used, if you used the financial calculator method, you should have got 4063,500 for your net present value total. And if you used the present value factor method and added up your present value factors, sorry guys, I've got, you would have got 4063,500. And if we had have used, I don't think this is going to delete now, is it? I hate this thing. Just hold on a second, let me fix this. Oh no, it's not working. Oh, there we go. I want to delete that. Calculator version would have given us, where's my total? Here, 4060,930. And if you use the present value factor, you'd get 4063,500. So that's just rounding total. So just you do your calculation. Don't worry about that total. You'll get method marks anyway if you've done this method correctly. Whatever your total is at the bottom, you will get method marks for that. So again, take note, in year 2, we had to subtract the extra 200. In year 4, we had to subtract the extra 300. In year 6, we had to pay out that extra cost of 1250. And at the end of year 7, we sold our facility, so we had an extra inflow of that 6.5 million. So those were our final, your final cash flows for those particular years are going to be these amounts here. Whoops, these amounts here at the end. Okay. So even if you don't have a financial calculator, you can write your answer down like this. And in this column, you must write down what the action is, or which key on your financial calculator you're going to press in order to get the correct answer. So 11% is our cost of capital for Joburg. So that gets programmed into the interest key. And then we go comp, NPV, and we'll get our total. in this one, if you guys remember, you type in each rand value and you press the enter key or the data key on your financial calculator. And when you get to, yeah, that's correct. You press enter to program each of those amounts into the data key. And then, if I remember correctly, but it'll be on that that PDF that you've got for the financial calculators. You press, where's my calculator? You've got to press that down arrow so that you can enter in the percentage, and then you go comp NPV, and it will give you the present value. But just practice these the keystrokes so that you get those correct. I don't always remember them when I'm talking quickly online. And then we're going to do the same for Durban. And remember, they said we had to calculate year 2 was an increase of 15% from year 1. We had to incur an extra expense in year 3. And in whatever this year is, the last year, we had to, the inflow was only going to be 80% of the previous year. And then in addition to that, we were going to sell the facility for twice, 2 times the first year's inflow. So our final cash flow for that last year is 8760. So you can see none of these calculations are difficult at all. You just have to keep your wits about you and take it easy. Read carefully, highlight, make notes so that you don't make mistakes. And then don't forget, Durban has got a different cost of capital. They gave us 9% as the cost of capital for Durban. So we must use 9% to work out the net present value for Durban's cash flows. And then you can again use the financial calculator version to work out the annualized net present value. So ANPV, we are solving for PMT. It's comp PMT. So we program into our calculator, Joburg has got 7 years worth of cash flow. Cost of capital is 11%. The present value is, and just remember this one here, we changed to 4063, whatever it was. And then always, excuse me, also remember, I don't think I'm going to be able to, okay, let me just delete that. I'm going to go here. Let's see if that will fit in. When you type in a present value on the calculator, you must put a minus in front of it. So you would have typed in minus 4063,500 for the present value. And then just remember this 11 here, that amount is incorrect. Okay. And then comp PMT, and then that gives you, which is now the annual cash flow. So in other words, if we worked out the future value of an annuity using this amount as our PMT, we would get this value here. And the same thing, we do the same thing for Durban. So Durban is 5 years, 9% cost of capital. We use our answer for the net present value for Durban, and that must also have a minus in front of it when we type it into our calculator, comp PMT, and we get 1310. They asked us to make a decision. So out of those two, we can see that Joburg is going to generate the highest annual amount if the two projects were annualized as an annuity. 2.5 million per annum is more than 1.3 million per annum. So we are going to choose Joburg, because again, give a reason, it has the highest annualized net present value. You could also use the manual version, so instead of doing ANPV using the calculator version, you also take the manual version is net present value divided by the present value of an annuity factor for that particular cash flow. So for Joburg, for instance, you would take the 4063,500 and you would divide that by, look up on your tables, present value of an annuity table, for 11% and 7 years. And you get a factor of 4.712. And then that will equal, and it will be 862, I can't read my own handwriting, 638. 862, 638. Okay, this answer here should be 862, 368. Because that was incorrect, this on the memo is also incorrect. This is one of the reasons why we're not allowed to distribute memos to students, because often on memos, when we work with the memos and we start marking, we find various errors and anomalies on the memo. We discuss it amongst the lecturers, and there's a forum that it has to be agreed on as to what the correct answer is, and then all of us mark with the adjusted memo, which obviously if we just sent the original digital version to the students, that version would not include all of those corrections. And then the students would study or practice with memos that had mistakes in them, and that would be horribly confusing for the students. So that's one of the main reasons that we're not allowed to send memos to you guys. Lots of the memos don't have errors on them. This particular memo, for some reason, just did have quite a lot of errors in it. And then for Durban, same calculation, the net present value, 5098510, divided by the present value of an annuity factor, this time using my present value of an annuity table and 9% and 5 years. So 9% and 5 years, you've got 3.89 from the table. And that should give you, there will be rounding differences. It'll give you the same answer that we got using the financial calculator. Okay, so either one of these two methods, the manual, what I call the manual method, or the financial calculator method, it really doesn't matter. The choice is the students. If they haven't specified in the paper, you guys can use whichever method you want to. Okay. So that was quite a nice question for 45 marks. So again, if you guys knew all of that work so far, this paper, your question 1 and question 2 are not bad. So that's 50 marks of the whole paper that we've gone through already. I'm going to go ahead. I see it. We're coming up for 7 o'clock, but I'm going to quickly go ahead and do question 3, which is another 25 marks, and then I'll finish off for this evening. because question 4 and question 5 are both quite long questions. So I'll record those separately for you guys and then upload that for you before you write your paper. So you've also got the whole of the 2023 paper as recordings as well. So let's go and have a look at question 3. So this is for 25 marks. And this is learning unit 4. Which is interest rates and bond valuation. So in this one, we have got, and again, I always read with my highlighter in my hand. Mr. McEnroe has received 1.2 million from whatever. He'd like to invest the money. He's advised him that with blah, 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 he should consider investing in bonds, which provide a more stable cash flow. He only has 10 years to go to his retirement, so that's significant. We know from today he will be retiring in 10 years' time, and he should purchase bonds in Topspin Limited. So Topspin Limited offers 20,000 Rand par value bonds. So what variable is 20,000 Rand par value in our bond formulas? That 20,000 Rand will be our future value with 10 years to the maturity date. That 10 years is going to be our value for N. The bonds pay a coupon rate of 18% per annum. So we will use 18% to calculate the PMT of the bond. That will be 18% multiplied by the par value will give us the Rand value of each year's PMT. And then interest on the bonds is paid quarterly. So 4 times a year we will get paid interest. So there M is going to be 4. The current annual required rate of return is 2/3 of the coupon percentage. So a required rate of return, that is what we are looking for our value of R in our formulas. So we immediately know there's more than one compounding period in a year. So we must use N times M. Why did I do that? N times M and R divided by M. And if you're going to use the financial calculator version, we also have to divide our annual PMT by 4 so that we know the Rand value of each of those 4 payments throughout the year. Okay, so do you see how I've read this question? By the time you get to the end of that, you already have got all your information sorted, and you're on top of this question. Required, calculate the profit or loss that he would make if he sold the bonds, if he purchased them today, okay, but then he urgently needed to sell them after holding the bonds for 80% of their duration. So after 80% of their time, then he sold them so that he could then put down a deposit on a retirement home. So remember, when we value a bond, see if I can fit this in at the bottom here. When we value a bond, we use the remaining number of years left to maturity for N. That's one thing that students get wrong. How many years are left in the bond, and that's what we use for N. So we are going to purchase the bond today when there are 10 years left to maturity. So the first valuation, what price did we pay for the bond today? Because have a look, we've got FV, N, M, PMT, and R. So what is the variable that's missing? What do I have to calculate? I've got to calculate present value. I've got to calculate present value, or i.e. The bond price at time 0. That's we're going to comp PV, or if you are using the bond formula, you are going to calculate BO, B0, that is the missing variable. So we're going to value the bond today using this information, and then we are going to value the bond. So 80% of 10 years is 8 years. So in 8 years' time, he is going to sell the bond. So if he has held the bond for 8 years, there will be, there will be 2 years left to maturity. So when we calculate what the price of the bond is on the date that he sells them, we are going to use 2 for N. Okay. So obviously when he sells them, the par value will be the same. We know what the value for N is. The PMT will be the same because that's fixed with the bond. M is still the same. It will still be quarterly. And the current rate of return has changed. So down here, required rate of return is expected to have increased by 3% at the stage from when he first purchased it. So whatever you worked the required rate of return out to be here, you're going to add 3% in your second calculation for what was the price of the bond when I sold it. Okay, so do you see how you've got to read your information in this question carefully, sort it all out, know what it is you're going to calculate, and then you can go and do your workings. So let's have a look at the workings. First of all, what's the price of the bond today? So we've already established this all. We can quickly write it down now because we've already made all our notes on our question paper. FV is 20,000. That's the maturity value of the bond. N is going to be 10 times 4. Remember, it is N times M. So N is 40. PMT is going to be par value times 18% coupon rate. And then we must divide that by M, which is 4, because that PMT is going to be paid out in 4 individual amounts throughout the year. I is, they said, 2/3 of the coupon rate. So the coupon rate is 18% times 2/3. That's our value for R. And that must also be divided by 4 because it is R divided by M. Okay, so remember this is here is N times M. This is PMT divided by M. And this is R over M. Because compounding is 4 times a year and not only once per annum. And then we can comp PV, and in this case PV will give us the present value of the bond, i.e. the price we paid for the bond today. Okay, so that's exactly the same as in your formula B0, the price of the bond today. Then now that we know what price Mr. whatever his name is going to pay for the bonds, we can take the total rand value that he has got to invest, which is 1.2 million. We divide that by the price of today of the bond today, and we can work out that he can buy 45 bonds. If I remember correctly, this didn't work out to exactly 45. 1.2 million divided by 26,934.43. Yeah, it actually works out to 44.55 bonds, and they have rounded that up to 45. It's a little bit tricky for students to know what to do when you get a decimal like that. So I will mark accordingly if it's a decimal, if you leave it as a decimal, that's fine. If you round it up or if you round it down, I would accept that, because I know it is confusing, and hopefully in a paper that it would calculate to a whole number. But obviously it's unlikely when we've got these strange numbers for the price of a bond. Then next we've got to work out what is the price of the bond, what price for the bond is Mr. McEnroe going to get in 8 years' time when he sells the bond. So FV, maturity value or par value, is still going to be 20,000 unchanged. N is now, I don't know what they did here, 10 times 1/5. Remember it said 80% of the 10 has gone, so I would have said 10 times 20%, which is 2 years left to maturity, and again it's N times M, so 2 times 4, so N is 8. PMT is going to be exactly the same because the coupon payment on the bond doesn't change throughout the life of the bond, so that's still par value times 18% divided by 4. Our value for R has now changed because they said the required rate of return has increased by 3%. So it's our original 12% plus an additional 3%. So R is now 15%, but because it is R divided by M, we must 15 divided by 4. So you will type 3.75% into your calculator or use 3.75 in your formula if you're using the formula. And then comp PV, or calculate the value for B0 if you are using the formula, and you get a selling price of 21,020.42 in 8 years' time. So today he will pay 26,934 for those bonds, and in 8 years' time, when there are only 2 years remaining before the bond expires or matures, he will be able to sell them for 21,020. The question was, what will his profit or loss be if he sells those bonds? So the overall profit or loss is the original price that he paid, 26, minus the price he will get when he sells them. So he will get 5,914 less per bond than what he originally paid for them. And that's understandable because the bond has now only got 2 years left to maturity, so it will sell for less in the marketplace, even regardless of whether the required rate of return has changed. And then we multiply that price, the difference per individual bond multiplied by the 45 bonds that he owns. So his total overall loss will be 266,000. And that is then your final answer. Okay. So have a look at the calculations we had to do. Calculation of the price today. How many bonds was he able to purchase with the amount of money that he had at today's price? What price will he get for the bonds when he sells them? And then what will his overall profit or loss be if he has to sell them in 8 years' time? Okay, so let me just have a look. So, okay, Dylan says he would have rounded to 44, and I would have accepted that, Dylan. That's absolutely fine. Yes, it would have made sense to round down because obviously we can't buy 0.55 of a bond. So if you had have rounded down, I would have accepted and marked that correct. No problem at all. I will always look at the logic that a student has used in their answer. And remember, it's always, if you explain your logic on your paper, write it out and say, answer is 44.55, rounded down to 44 because whatever. And then that always helps me to be able to give you more marks. Okay. So guys, it's 7:10, so I must stop now in case you guys have got another class at 7:30. So Christopher wants to know, do you have to indicate that we would have rounded up or down or just say 44? It is best if you state what you've done, because then I can follow your train of thought. I can follow the logic that you've used, because remember, I must test that your logic is reasonable. That it makes sense financially, that's what a person would have done. If you had have just used 44.55 and not rounded, I would also have accepted that. If you had have sort of got that and then not known what to do, must I round up or must I round down or must I round it all, I also would have accepted that if you didn't do any rounding at all. So remember, the more information you give me on the answer page, the better. You're free to write whatever you want. If you want to write me a story about why you've done something in one of your answers, then write that. You don't have to stick to only writing FVs and PVs and not anything else. Anything that you think will help you to get more marks is fine. Okay, guys, I'm just going to stop the recording.